G'day and welcome to Subject to Finance on Monday the 20th of October. Today I'm going to talk a little bit about some things that I saw in the media last week, which I think people out there will have been looking at, including yourself, around inflation. Is it over? Are we trending in the other direction? And yeah, the thing that struck me is that I saw a graph that basically showed a whole lot of indicators with green directional arrows showing that we're kind of on the way out of this whole recession and that inflation is under control. And I think that's generally, to some degree, true. But I guess some of those things could be deemed as red arrows as well. So let's talk a little bit about that today. So what's been happening? In the last week we've seen some sort of rallies going on in the US market, and I'm going to talk a lot about the US market today because it really affects us. We're a small country. What happens in terms of those big economies such as the US really matter to what happens in our economy. A lot of our funding base is out of offshore markets, largely the US. Even if you trace that back through Australian banks, where do they get their wholesale funding from? You're going to find that you end up back in that US market in some way or another. US has a huge effect on us in terms of our overall positions, and as a export-led trading country, everything from our exchange rates through to our wholesale funding rates are affected by it. So I'm going to talk a lot about it today. You can't just sort of focus on those New Zealand numbers alone and understand them. So what we've been hearing this week, or last week actually I should say really, in terms of marketplace is that most of the things that you need to see as a reserve bank to be comfortable that you've got inflation under control are happening. So we've got the likes of spending coming down, prices coming down, employment nudging up, unemployment nudging up, and those things generally indicate that your inflationary issues are coming under control. I'm going to switch over here to the US because the US had a really interesting week last week. They had Treasury rates coming down. They had unemployment going up beyond what most economists had forecasted. They had wholesale prices going down below what most economists in the US market had forecasted. They had consumer or retail pricing coming back by more than what most economists in that market had forecasted. So you have three significant things there. Unemployment in the US is the highest in 2 years, and as those bond yields start to move lower, what you start to see is the equities market, the share market in the US starting to go up. And so those are real strong indications that the US is starting to get control around its inflationary issue. So coming out last week, similar indicators from the UK market. I haven't gone and looked at a whole lot of other markets, but generally there's this sort of trend in those larger financial markets that inflation is coming under control. So with that in mind, I kind of went and had a look at what our forecasted swap rates are doing, which is interest rate forecasts in a way, looking forward in time as to what the Treasury markets are forecasting in terms of interest rates for New Zealand. So the swap rate is kind of like the wholesale rate, if you like, before margins put on it, and that margin is the component that the banks like to keep in their back pocket as profit if you want to consider it in a simple light. What we've been seeing is that those swap rates have actually started to trend down, and I've talked a lot about swap rate rates in the past, and they've sort of been bouncing along a bit of a plateau for a while. But the interesting thing just at the moment is they've come off a little bit more substantially in the last little while than we've seen in 4 or 5 months. So it's sort of interesting to look at. The 1 year swap rate is the forecast rate for if you want to think of a 1 year home loan fixed rate. It peaked in around about the 4th of October, so getting on for a month and a half ago at 6.04%. and it's dropped back down to around about 555 at the moment. So it's a good 50 basis points down on where it was, and that's quite a significant drop. So here's a chart that sort of shows that trend, and you can see that there's some significant movement happening there with that 50 odd basis point drop. At the same time, the 5-year rate has also seen some significant downward pressure. If we look back to around about the same time, the 5th of the 10th, so not even a month and a half ago, 5-year swap rate was at around about 5.39%, and today it's sitting around 4.75. So again, more than 50 basis point drop there, as you can see in this graph that I've got up on the screen in front of us. And so in my view, what we're starting to see is that the inflationary pressure is turning, and I think reserve banks are going to start acknowledging that, and are probably, as most of them have indicated, at the top of their rate cycle, including the New Zealand Reserve Bank's OCR cycle. And it's really just probably a wait and see as to what happens, because I think the banks will lag that movement in terms of some of the short-term pricing that they've been playing around with in the last month or so. But rolling on through Christmas, and Christmas is always a bit of an abnormality because we see, sort of market activity we don't see at other times of the year. But I'm guessing that rolling on through Christmas, if we see these trends heading the same way, then some of the conversation will be around interest rates coming back off at some point in time. Most people are still indicating that there's a plateau to be had there. Antonia Watson, I think I heard her on the radio talking about a plateau. How long is that plateau is the question, and I think what we're seeing with these offshore trends is positive for us as well, in that it might shorten up that plateau a little bit. But having said that, it's not unreasonable for us to expect that interest rates are going to remain in that sort of middle ground for a while, and that's what these swap rates indicate. If we look at the 5-year swap rate at 4.75, it's saying that longer term we're expecting rates to stay not down at the 2% sort of mark that they were, but not up in the 8s or 9s either potentially. There's some room for them to come back over time. The hard thing with all of this is that banks have got to protect profit, and out of that margin they've got to run a business. So they'll want to hold on to some of those margin gains that they've made in recent times, because they want to, make sure that they've got strong profits through the remaining cycle in terms of this downward cycle that we're in, so that they can afford to, one, look after their shareholders' interests, but also to have provisions in place for any adversity. So yeah, that's it for me this week. I just wanted to sort of give that sort of indicator that, yeah, it does look like we are onto a different trend than we have been from looking at those swap rates, and we may have gone over the top of the mountain. Next week I'm going to come back to some of the valuation stuff that we've been seeing out of QV over this last week or so, and how that correlates with what CoreLogic saw in earlier months, and whether or not we are kind of coming off the bottom of the plateau when it comes to real estate pricing indexes, and whether we can expect to see those going up. So have a great week, and we'll talk more about that in the near future. Cheers.